right, my name is Ogochukwu Theresa Ugwunna, and my co-author is Anastesia Ezewulu. She's not here presently, but I'm leading the presentation. So this work is on impact of monetary and fiscal policies on stock market capitalization of 5 selected African countries. First of all, monetary policy simply refers to government policies taken through the central bank to stabilize and control the circulation of money, that is the money supply or the interest rate. And the goal is normally to stabilize the economy, especially to stabilize the price rates. Then why fiscal policy are government decisions taken to stabilize the economy through government expenditure or through tax policies. Then across the globe, a well-functioning stock market of an economy plays an important role in the economic growth and development. Excuse me. Oh no. Okay. Across the globe, a well-functioning stock market plays an important role in economic growth and development by facilitating the mobilization of financial resources for productive investments between businesses and institutions that need the capital to innovate and grow. There has been a major growth in African stock markets due to increasing interest of foreign investors because many African countries offer high investment returns. Currently, there are 29 stock exchanges operating in Africa, with a combined market capitalization of around 1.6 trillion US dollars. The 5 markets selected in this study, the 5 countries selected in these studies are South Africa, Nigeria, Morocco, Egypt, and Kenya. They are selected based on their market capitalization. They have the top stock exchanges, that is the highest market capitalization in Africa. South Africa is leading, followed by Nigeria, Morocco, Egypt, and Kenya. As you can see from the table, South Africa has about $1.36 trillion market capitalization. That is column 4, row 4. Nigeria has 6.7 billion. Morocco has 65.3 billion. Egypt 35.7 billion, and Kenya 17.19 billion. And we also listed the company. We also have the company, number of companies that are listed. Then African government has also implemented reforms like the exchange trade funds and real estate investment trusts to help to improve the stock market and attract investors. But notwithstanding this positive development, African stock markets still encounter problems. Therefore, the objective of this study is to examine the impact of monetary and fiscal policies on stock market capitalization of selected African countries, that is South Africa, Nigeria, Egypt, Kenya, and Morocco. These countries, this study is selected based on the literature gap, which shows that many studies have actually carried out the impact of these policies on stock market, but they are carried out for individual countries. So this study differs from previous studies because it's looking at a panel study using the countries with top market capitalization in Africa. Oh my God, I cannot see my screen.
Kindly, would you please go back to your presentation?
Sorry, I cannot see.
And close Microsoft Teams.
I cannot see. Okay, yeah, thank you. What is that? I've listed the literature gap. So under the methodology, this study is based on the Keynesian theory because Keynesian theory suggests the combination of automatic stabilizer and discretionary measures in achieving macroeconomic objectives. Remember, discretionary measures has to do with reducing the government expenditure. Then for this analysis, we have our model specification.
Excuse me, sorry. Please, Dotun, can you stop sharing? Dotun, Olawale followers?
Okay.
Stop sharing, then we can see the presenters profile. Because we are viewing now Dotun Olawale. Please, can you stop?
Okay. Can you hear me now?
And
Can you hear me now?
I can hear you. Can you start sharing your presentation again, please? I think someone started sharing the screen, so we can't see. Yeah, please start sharing your share your presentation again, please. Thank you.
The model shows that we have the stock market capitalization as dependent variable, money supply, government expenditure, interest rates, inflation rates, and GDP growth rate as independent variables. So money supply and interest rates are proxy for monetary policy, while government expenditure is a proxy for fiscal policy. Then other ones, inflation and GDP growth rate are the control variables. We carried out the descriptive statistics, which shows the mean, maximum, and minimum values. And you can see the number of observations have 115 observations, which means 5 countries across 13 years. We use 13 years from 2000 to 2022. And for 5 countries, which gave us 115 observations. We also carried out a panel unit root test, which shows that 4 of the variables are integrated of order 1, while 2 are integrated of order 0. And we adopted the vector error correction model, which helps us to carry out both the short-run and long-run dynamics of the results. As on the table, the second column shows the long-run relationship, while the 4th column shows the short-run relationship. The first column, the first one is the coefficient. The second one, the one in parentheses is the standard error, and the one in square bracket is the t-square. As you know, the rule of thumb for significant values, when it is greater than or equals to 2, it means that it's significant. So for the first variable, money supply, 9.3 is greater than 2. For interest rate, 3.0, in absolute terms anyway, 3.0 is also greater than 2. And then GDP growth rate also has 4.3, which is also greater than 3. So we say that the monetary policy instruments are significant in the long run, but the fiscal policy instrument, which is the government expenditure, is less than 0.2, as we say 0.398. So it is not significant in the long run. Then going to the short run, the error correction model is significant. It's also rightly signed because it's minus 0.33. Then other variables, both the monetary policy instruments and fiscal policy instruments, are not significant in the short run. Therefore, our findings now indicate that there exists long-run relationship between the monetary policy instruments in these countries than the fiscal policy instrument. So specifically, monetary policy only has statistical significance. Monetary policy has statistical significant effects on stock market capitalization of the 5 selected African countries in the long run. But in the short run, all the monetary and fiscal policy instruments are statistically insignificant. The ECM result shows that the model adjusts towards the long run equilibrium at the speed of 33.7% per annum, given any past shock on the stock market capitalization. Therefore, our recommendation is that the policy stakeholders should be more concerned with the long-run policies than the policies of the short run. That does not mean that policies of short run should be thrown away. Instead, they have to look for bottlenecks that prevent the stock market not to contribute to economic growth in the short run. Maybe not supervising the financial institutions very well, or the regulations on the institutions that prevents them to contribute to the economy in the short run, because there is need for the stock market to have a good impact on the economy. So that's the end of the presentation. Thank you.